Hello viewers, welcome back to another episode of accounting tutorials at our YouTube channel. And today we are going to look at the qualitative characteristics of accounting information. In other words, we are going to look at the qualities that accounting information should have in order to be accepted and the standards on which it is supposed to be. Now this is going to be our lecture number 2. Financial accounting, and we are going to look at qualitative characteristics of accounting information. Now, accounting information can just be produced by anyone or even produced in any way someone feels like. Therefore, this financial information, for us to use it or to be taken over by the users of this accounting information, it is required to be produced in a given form. It's not that you can just produce it in any format that you feel like. Therefore, for accounting information to be accepted, there should be some qualities that it should possess, and there are mainly 2 classifications of these qualitative characteristics we should have. One of them, we have the fundamental characteristics, and we have the second one is the enhancing characteristics, XTICs. And the fundamental characteristics, or fundamental, means that we cannot do without them. They are fundamental. We can't do without them. And it's basic that we should always go by that. But this enhancing also helps to increase or enhance the quality of the information that the accountants have presented or they have produced. So basically, we have the fundamental qualitative characteristics, and we also have the enhancing qualitative characteristics or features. And these are the 2 broad classifications of qualitative characteristics or the qualities of accounting information. And we should try and understand what these call for, or what do they really mean, if at all we want to look at the accounting information. So we want to pick one by one so that we can start understanding before we start doing the computations, because we say the accounting information is going to be needed by the users to make informed decisions. But this accounting information has qualities. These are qualitative characteristics that, or features, that this accounting information must have so that they can be accepted by the users of this same accounting information. So I want us to start by looking at these fundamental qualitative characteristics, and then we go ahead and look at the second one as enhancing. Now, fundamental qualitative characteristics are basically two. These also goes ahead and they are categorized. We have relevance and faithful representation, and that's what we are going to look at in detail when it comes to the fundamental features. And when we get to the enhancing features, that means that these are features that are going to help us increase the quality, and these are 6. There are only 6 in total. So we are going to start looking at the fundamental, then we look at these enhancing. Here we say there are 6 in total. These ones are 2. So we are going to look at each of them. So let's start looking at the fundamental qualitative characteristics. Now, the fundamental qualities, as I said, there are 2. Number 1, we talked about relevance. And number 2, we looked at faithful representation. Faithful representation. But for relevance, when you focus on relevance, our number 1, we say that financial information must be relevant, and then it should be faithfully represented. And we are going to explain each of these in details. We want to understand if the financial information is supposed to be relevant and at the same time is supposed to be faithfully represented. What do we mean by that? So we want to look at one of them, each of them in detail by giving what exactly do we mean by relevance and what exactly do we mean by faithful representation. So let's start off by looking at the relevance. Now, relevance of financial information means that it must serve the needs of the users. It must serve the needs of the users. That's the meaning of relevance. It must serve the needs of the users. It must serve the needs of the users. For example, if I need information on sales, if specifically I need information on sales of the business, then the information that is regarding maybe to purchases, information regarding to assets, information regarding to liabilities, and other information will not be relevant. Because me, what I'm only interested in, I'm interested in looking at the sales of the business, the turnover of the business. If I'm only interested in that, then if I see information that is regarding other areas, it will not be relevant to me. But also, Relevance professionally, it means that we should be able to make a difference. Now, relevance, if we say we want to be able to make a difference, what do we mean? We mean that financial information should be capable of making a difference in the decisions that have been made. In other words, if I get the information on sales and it doesn't help me, it doesn't make me change the decision that I came with, then it's not relevant. So it is going to be, the information should serve the needs of the users, but at the same time should be able to influence or impact the decisions that have already been made. So remember, we said that accounting is essentially recording of transactions and summarizing them in financial statements, so that the users of these financial statements will use them to make their decisions, which are informed. So if they can't use the same information to make a judgment or to make final decision, then it's not relevant, because information is only going to be relevant if at all it can influence what I can say about it. If the workers have been working well and I'm looking at payment, the salary we are paying to them, it should make me make decision, maybe whether we increase the salary or they are performing badly, we reduce their salaries. So it should impact the decision that has been made already for the information to be relevant. Therefore, financial information is not relevant. If the financial information is not relevant, then it would not make any difference in the decision that is made. For example, if I'm talking about a decision, if let's say I'm about to make a decision and then I get a relevant information, that relevant information should impact my decision, or it should impact your decision. And that's what we are meaning, that it should be capable of making a difference in your decision. As long as you get the information that you need, it should be able to impact the decision that you are supposed to take. Therefore, it should be able to tell you which direction to take in the decision that you are going to make. And if it is capable of doing that, then we can conclude that that information is actually relevant. However, there is something that we need to note. Relevant information will not be able to make a difference unless it has some qualities. If you want the relevant information to make a difference in the decision making, then there are qualities. There are some qualities. There are some qualities that relevant information should have. Now we need to understand what are some of these qualities that the relevant information, if at all it's to make a difference, it should have them. Now, one of them, it should have a predictable or a predictive they call it a predictive value, or it should have a predictive value or confirmatory value. It should have any of these, or it should have both. If it doesn't have one, then at least it should have both. Any of this works. If it is capable of having both of them, it is okay. Now, either of these or both will work. Now, what do we mean by predictive values and confirmatory values? Because someone is going to be wondering, what are we meaning by predictive values? Now, when we say predictive values, it means that the information should be able to predict future trends. The information that you are receiving should be able to predict future trends in the same financial information. So, if you have the information, but you can't predict what will happen next, if you have financial statements of this year, but those financial statements can't help you to predict what the financial performance for next year will be, then we can't say that they have a predictive value. So the information is going to be predictive. It's going to give a predictive value if at all it can be able to predict or forecast future trends in the same financial information. For example, if we are looking at maybe these financial year's statements, if you're looking at financial statements of this year, or maybe we are looking at financial statements of, let's say, 2023, 2022, and 2021 for 3 years. Now, if we are looking at the last 3 years of financial statements in an analytical way, when we are trying to analyze, then we should be able to use these same statements to predict future performances of the same company that we have in the question. If, let's say, we have financial statements of 2023, 2022, and 2021, we should be able to study the trends within these previous year's financial statements to be able to tell that in 2024, the performance is going to be like this. If we are able to do that, therefore we say that these financial statements have the value to predict future performances or future financial decisions that we can say. So, it has a predictable value if at all it can be able to predict what will happen in the future. Because if you have 3 years financial statements, you can actually predict more. You can actually predict maybe in 2 years' time or 3 years' time we shall be having this. But we are based on the historical things, because remember, these financial statements are going to be presented on the historical data. Now, let's now look at the confirmatory value. Now, confirmatory value, it's one of the things that at least must be there. If we don't have a predictive value, then it must be a confirmatory value. Confirmatory comes from the word confirmation. You have confirmed, meaning it's a confirmed value. So the confirmatory value is that after we have calculated the financial statements for the performance of the business, maybe we have computed, because as I said, we may be having 3 years, 2023 up to 2021, 3 years, the previous 3 years. Then we can do some computations, we do some analysis, we compute in the future, that in the future we shall be having this and this and this and this and this. Then, for these financial statements to have a confirmatory value, they must confirm that those figures, they will actually happen. In a sense that we have computed our profitability or the performance of the business in the future. Maybe we have computed the financial statement, the financial statement of financial position, or the income statement of 2023, 2024. And now we've seen that we can be able to confirm that these are the things that we are going to get. Now, the word confirmatory is going to happen in the sense that if we are in the year 2024 and we've prepared 2025 financial statements, it is going to be confirmatory if at all we reach in 2025 and the things we projected, they are the ones that are actually happening. We say that relevant information had a confirmatory value because we could confirm the things that we had projected. That's why they are saying it should be either of the two or both. But in my opinion, I see if you have both, then it would be more realistic. So if you go into the future, you can look back and say that you confirm that what we predicted actually came into existence. So we are basically looking at the predictions that we made and we compare with the actuals, because by the time you are confirming, it means you know what actually happens. So you'll confirm that these finance statements have been able to predict accurately, because we are now in the future, we can actually see that the things we predicted came to reality or they materialized. And that's what we mean by confirmatory value. So whenever you are looking at these financial statements, we have to look at, before it can make a difference, before these financial statements can be able to make a difference, you will have to either have predictable values or predictive values, or have confirmatory values, or both of them. And we are concluding that both of them are, if both of them are there, then the information will be more relevant. The financial information will be more realistic to the users, because it will help them make decisions that can materialize, because of the two characteristics being, or the two qualities of relevant information are being seen. Now, I want to talk about the fact that financial information is affected by materiality. Now, I want to explain, because there is no way you are going to talk about for relevancy minus talking about materiality. Now, let's look at relevance and materiality. Now, we can, as I said, we can't talk about relevance without mentioning materiality. And we need to understand what materiality means. And when we are looking at materiality, materiality itself means that information to be able to make a difference, or the ability to influence a decision of the user. That information, in other words, if that information has the ability to influence the decision of the user, then they will say that information is material. There are two issues. Materiality has two issues. Either information is going to be material or it's going to be immaterial. Now, material means that the information is actually true. It is significant values. In other words, it gave you exactly what you expected from it. Now, what brings in this concept of materiality is the sense that there could be some deviations. I may be expecting to have a profit of 1.5 billion. And maybe I get a profit of, let's say, 1.49 billion. We can say that 1 million that is pending to make the 1.5 billion is immaterial. Of course, this one will be, maybe it is 4.1449 to be 1 million. We can say that this materiality is there. If you get almost, the figure you've got is close to 1.5. Now, if I intend to make 1.5 billion, 1.5 billion in profit after tax, but I make 1 billion, then this variance of 0.5 billion or 500 million is, the difference is actually material. It's like if you have made a loss, if let's say you have an error in your accounts, instead of saying maybe it is 1 million, let's say 1 million, let's say 21 million, and someone wrote maybe 21 and he put maybe one extra 1,000. That extra 1,000, that 1,000 can be, it is immaterial. In other words, it is insignificant. If at all you are dealing in millions, but you have only 1,000, that one you can say you can easily neglect or you can easily ignore. But if let's say the deviation is 2 million, there is no way you can ignore this, yet you are working in millions. So materiality also happens in that perspective. I don't want to go deep into what it is, but I just want you to understand the how materiality relates to the information, because most of the time materiality is used in auditing, where companies set their material values, that if you audit accounts and you find maybe the accounts are lacking, because materiality, for a figure to be material, it means it has potential of changing the profit to a loss, or it has a potential of changing a loss to a profit. That figure is going to be material, if I may put it in that general perspective. If we have been making a loss of 2 million, but you are saying you made the error somewhere which is 3 million, it means this error you made of 3 million is material, because it can change this profit, this loss you made, into a profit of 1 million. But it will be immaterial if at all you made an error of, let's say, 2,000. But when the accounts are showing a loss of 2 million, this 2,000 can't change the loss that you already incurred. So that's what we are meaning by materiality and something being immaterial. Something is going to be immaterial if at all it can't change anything. That's what we are trying to mean from that perspective. Now, I was saying that materiality is the ability to influence the decision of the user. If the figure is very high, it's going to make the person accept the financial statements or doesn't accept the financial statements. Now, materiality is relative. In other words, it keeps on changing. It is dependable. It depends. Some organization, a figure in some organization, 1 million can be material in a small organization, but it can be immaterial for an organization that is having maybe a lot of cash flows. Now, if let's say we have a company earnings after profits, they are in billions. We've made billions of money. If you are that company and you have billions of money, let's say the profit after tax is 12 billion, 20 billion. Then this 1 million can actually be immaterial because it can't change anything. But if you are that company, your profit after tax is in 2 million, this 1 million will actually be a material figure, because if you add on this 2 million, it will increase the profit by 3 million. That's why we are saying that materiality is relative, or it depends. Organizations with a higher cash flows will actually see some values to be material, yet from other institutions with less cash flows can see that as immaterial. So if a company is making billions of money every year, then there is a misrepresentation. Like if let's say there is a transaction of just like 1 million, then you just know that the auditors can actually ignore that. So the auditors may decide to ignore that because it's not material, it's immaterial, meaning it is too small as compared to the size of the profit of the company. And that's what we are looking at. If this 20 billion is being made every year, if there is some error that was made somewhere of just 1 million, it can be looked at as immaterial value and it can be ignored. Therefore, that's why I'm saying that materiality is relative, because an amount of money that is material to a company can be immaterial figure to another company. If the amount is forming a very smaller portion to the bigger amount, then we take it to be immaterial. I hope you are getting the aspect. Therefore, what you need to understand is that materiality affects relevancy. It affects relevance a lot, because if the figure is material, then the information is not going to be relevant. So there is no way we are going to talk about relevancy and minus talking about materiality. And basically materiality is any amount that can cause an impact on the financial statements, either when it is included or when it is excluded. In simple terms, if you include it, it can increase the profit. If you don't, then it can lower the profit. So if it has that impact of changing the financial statements figures, then we say it is material or immaterial. For example, we talked about the ability of changing a loss-making company into a profitable company, and vice versa. You look at, if this 1 million, if the company was making a loss of 2 million, but you have material figure of, let's say, 5 million. You have 5 million that was in error, misrepresentation, or a transaction was omitted of 5 million. This 5 million, if it is included here, can actually make this company from a loss-making company to a profit-making company, and it will be having 3 million of profit. That's what we are meaning, and I hope you get that concept. And that's basically what the fundamental That's what one of the key elements of fundamental representation is all about. That is relevancy. But we said, as a matter of reminding, I explained what relevance is, and I also pointed out that if the information is going to be relevant, then we are supposed to talk about predictive value and confirmatory value. And I also said that there is no way you are going to talk about materiality, so the relevance minus talking about materiality. So let's now look at the next fundamental characteristics, which is faithful representation. Faithful representation. Now, faithful representation simply means that we faithfully represent what we should present. But let's understand that financial accounting or financial statements or the figures within those financial statements, the events which are quantified in monetary terms in those financial statements that we present at the end of every accounting period or at the end of the year. Those reports that will be produced by the accountant should be able to report everything that it should represent. It should represent every figure that we are supposed to report faithfully. However, faithful representation, for it to happen, there are three things that must happen, which includes the information should be complete. Then it should be neutral. And the third one, it should be free from errors. Now, if we want to represent this information fairly, in other words, under faithful representation, and before we say that these accounts represent the information that faithfully we are supposed to represent, or they represent that everything is faithfully represented, then it means that the financial statements are supposed to be complete. It means that the financial statements are supposed to be neutral. It also means that the financial statements should also be free from errors. And when all of these three factors are combined, then we can say that these financial statements have qualified or satisfied the quality of faithful representation. Now, I want us to look at, if we say these financial statements should be complete, what do we mean by complete? Now, when you look at complete, the completeness of these financial statements, you need to understand that whatever we do in this financial statement should be complete. So, in other words, it means that financial statements should record everything. They should record everything. They should record everything that is supposed to be there. In other words, when we are recording, we shouldn't take off some transactions. Because, for example, we are not supposed to do what we call creative accounting or doctoring accounts. That is all misrepresentation of facts, whereby you only take things that are okay in your perspective, then you leave out other things that you may think they are not okay for you. Therefore, these finance statements should include everything that happened within the accounting period. And once we have every detail summarized in these finance statements, then we can say that these finance statements are complete, because there is nothing that has been left out. Now, when we talk about neutral, finance statements being neutral, also we say that these finance statements should be neutral, in a sense that if they are neutral, it means that it's not being influenced or distorted by the person's wishes. It's not influenced by any other person, either in the organization or outside the organization. It shouldn't be that these finance statements are prepared as per the opinions of the accountants or those of the management. And that's what we mean by finance statements being neutral, because statements not being affected by any person, they are independent. It means that we are not going to have cases to do with creative accounting or misrepresentation of facts, because sometimes when we are preparing finance statements and we leave our personal feelings or personal wishes influence the way we are supposed to prepare these finance statements, we may decide that maybe we can exclude some of these values, we can omit some of the transactions, and also we put in some other transaction that you may think will create a good image for the organization. But as what we are talking about for the finance statements to be neutral, you shouldn't ignore anything. They shouldn't be affected by, or they shouldn't be influenced by any other person. Just like the way auditors are supposed to be independent, and they are also supposed to be both in mind, and they are also supposed to be seen to be independent. So these statements, they shouldn't be distorted by personal wishes or personal feelings. So we should report the same information as it is, and that's how we can conclude that these finance statements are neutral. And hence, if they are not neutral, then they will not be satisfying the principle of faithful representation. Now, when we look at free from errors, now this is the third point, or the third quality within the faithful representation that is supposed to be met. Finally, when you look at this, we are saying that finance statements must be free from errors. Now, the finance statements should be free from error, in a sense that we should do our best to try and reduce the errors that can be committed in these finance statements, to make them true and fair. They should be true and fair. But however, the issue here is that this quality does not mean that the finance statements can never have errors. Because in financial accounting, of course, we do a lot of estimates. We estimate things to do with depreciation. The way we treat depreciation, you may find we are using different methods. Other companies are using different methods. So there is no standard way of doing this depreciation. Provisions for bad debts. So there are many estimates that we do. These estimates may be wrong, may be right, but we are saying that we should try our best, because some of these estimates are going to be made, but some of them are going to affect the finance statements. Because if you charge depreciation at a very high rate, you are going to find yourself having more expenses to be deducted from your gross profit, and that will reduce your net income. But what we are saying for the errors, what we mean here, being free from errors, is for us to do our best to reduce the errors that and make sure that whatever we have done is complete, and we have done everything at our best to try and eliminate errors that may be available. When all these three criteria are met, when you meet all these three criteria, then we can say that these financial statements can actually satisfy the faithful representation quality. So, therefore, that's what we wanted to know about the fundamental qualitative characteristics of accounting information. And having completed and understood the two issues in the fundamental qualitative characteristics, which are relevance and faithful representation, so we can now move on to the second qualitative characteristics of financial accounting, which we said it is enhancing qualitative characteristics. And we said there are 6 of them. There are 4 of them. So in total, we are going to be having 6. Now let's go and look at the second qualitative characteristics of accounting information, which is enhancing characteristics. And we are going to talk about the 4 of them. So this is number 2, qualitative enhancing characteristics. Now, these, we said they are 4 in numbers. And I want to explain them as we go on. But we said these help to increase the quality of our financial information. Number 1, let me go straight to them. Number 1, we have comparability. Comparability comes from the word comparable. It can be easily compared. You can compare years after years. You can compare within the year, or month after month, quarter after quarter. So that's comparability. So this means that the financial statements that are being prepared should have the quality of being compared with other financial statements, in a sense that if we are preparing an income statement, that income statement of company A should be capable of being compared with a financial statement of company C, because they are going to be using the same format. What we are going to be looking at will be the trend. Are these guys having more of sales compared to this? But the same format, it should be portrayed in a sense that it can be easily compared to other financial statements. Now, if you have to take note about, there are things that you are supposed to take note as compared to, as you're looking at comparability, because comparability has 2 different dimensions. The first one is that financial statements should be able to be compared with previous years. We can be doing comparison with previous years' financial statements. That could be one dimension, whereby we can, for example, we can check the financial statements for year 2023 with the year 2024 that we are in, or 2022 and 2023. So that's the first dimension. You can be easily compare the financial statements of 2023 and then you should be able to compare them with the finance statements of 2022, 2021, 2020, but because they are the same, they are being drawn in the same format for the same company. So as long as you are comparing the same company but within different periods, then we should have that kind of comparability. So if it happens, then we can say that finance statements have fulfilled have the ability to be comparable. And the second dimension of comparability is that they should be able to be compared with similar firms or companies in the same industry, whereby at least we can look at the industrial analysis so that our financial statements are similar to our competitors. If they are similar, or our rivals, if they are similar in the same industry, we are going to be able to compare. Then we shall be able to do trend analysis to be able to know whether we are performing better than our competitors or we are not. But they should have that degree whereby we can actually compare to other companies in the industry, other companies of the same industry. It will be hard for you to compare if the industries are not the same, but if the industries are the same, then we can try to do some trend analysis and be able to have that in mind. So those are the two dimensions of whether we are doing a back-to-back comparison, or we are doing, because a back-to-back comparison is like you are looking for the same company, but you are looking at the different years. That is what we call horizontal comparison with the same. It could be you are dealing with another company, but you are comparing, the companies are the same, but you are comparing the performance. But now, before comparability can be achieved, there must be things to do with consistency. There is no way you are going to have comparability if there is no consistency. If let's say these guys are using a different accounting policy, let's say we depreciate this year, we depreciate our assets at 20%. The next year we depreciate our assets at 30%. There is no way we are going to compare. If let's say this year we are using straight line method for depreciation, the next year we are using reducing balance, there is no way you are going to do the comparability. There is no way you are going to compare. So there must be consistency. If this year we are using straight line, we should use straight line throughout, maybe until when there are bigger changes within the organization. Maybe the organization has increased, more assets have been increased, then you can try to change. And even when you change, if you change from straight line to reducing balance, you stick to reducing balance up to a certain point in time. That's what we are meaning. We are supposed to have that kind of consistency. So consistency means that you should hold yourself, or you should hold on to one accounting method throughout, except when there are very big changes in the regulations and laws, because the laws can require you to adjust your accounting policies. For example, if the depreciation policy changes, you know the depreciation or the wear and tear from the tax point of view is different from the accounting perspective. Because for taxation, they give us the schedules that we use. But for accounting, we base on our company policy. So if you're a company and you are sticking to straight line, for example, then it means you should do your depreciation on a straight line method throughout, so that it can be easy for us to compare this year's financial statements to the other year's financial statements, because they are consistent in the policies that we've gone through to be able to prepare these financial statements. If you stick to reducing balance, then you should do that. If you are using sum of years digits for valuing your PPE, it is the same. So that's it. So you can't talk about comparability without talking about consistency. For you to be able to compare, there must be some consistency. Now let's go to the next one. This was number 1. Let's look at number 2. Number 2 is verifiability. So verifiability, that is our second enhancing qualitative characteristics or feature of financial information or financial statements. Now, verifiability means that financial statements can be verified. They can be verified from the source documents. In other words, if the sales I've put in my financial statement, I must trace back and I see if at all I'm using the same sales that is reflecting in those different day books. I must be able to verify the figures I'm presenting in my financial statements. And that's how auditing takes place. Because the auditors look at the source documents vis-a-vis the information you have portrayed in these financial statements to see whether these things are tallying. So that's to avoid creative accounting. So that's why the first step was actually for us to be able to register this information, recording and classifying these financial transactions. So those finance statements, they are supposed to be verified against the source documents to make sure that there are some consistency. We have the same figures. So we are supposed to verify from the source documents, whereby we trace and verify that this information that you have presented was not created by you, but there is a source document where you picked the information. And even when people comes and look at it, they can actually verify that these are the things that they were transferred to the financial statement, so they are true. And that's the quality of verifiability, because you can't just bring out figures minus having supporting documents. So you can't doctor accounts and say, because if you are to doctor the accounts, then it means you are supposed also to doctor the source document, so that those things can be verified. And that's basically what auditors do. Now, the fourth one is timeliness. Timeliness. Now, this is also the third enhancing qualitative characteristics of financial information, timeliness. Now, timeliness means that financial information must be presented and provided to the users in the time frame when it is still relevant to them. It must be provided to the users when it's still relevant. It's still relevant to them. So that if I need to look at the bank statement right now to verify something, it must be available. If you don't provide to me the bank statement when I need it, and you bring it when I don't need it, then it will not meet this timeliness qualitative aspect. So the other thing is also on the timeliness. It also means that when you are preparing these final statements, you should prepare them in the period when they are needed. Prepare these final statements within the stipulated period. Because there is no way you are going to bring for me a final statement of 2023. You bring it in 2025. It will not make sense. If I say these are our audited statements as of 2022, you can't give me these documents in 2025. It will not make sense. If they are supposed to be prepared in and when they are required by the users, because that's when they can be able to make an informed decision. And this is the same aspect, because we always prepare these final statements in one accounting period, for one accounting period. Every year we prepare financial statements. Now, the reason as why it is done every year is due to the periodicity concept. The periodicity concept says that financial statements are supposed to be prepared within a period of 12 months. And that's why you can't provide financial statements of 2023, you bring them in 2025. Because that wouldn't be timely at all, because we need to have those statements so that we can make relevant decisions. We get them when they are still relevant for us. Number 4, which is our last one, is understandability. Now, we said in the definition that we should also interpret the operating results for the users to actually make decisions. By interpreting them, we are trying to make them understand. So if we are not there to interpret, then we should prepare these financial statements in a way that can easily be understood by even those who don't have the accounting knowledge. So when we talk about understandability, the financial statements should be very simple. They should be simple to understand by all users. And that's what we are meaning here. For example, if let's say I was not classifying the information, I've been given tables, I've been given maybe cups, saucepans, spoons, and I don't put them under utensils. Because if someone doesn't understand what a utensil is, or if someone sees these very many things and he can't read them, when you are trying to classify this financial information, we are trying to make the users understand. We make it brief and simple, that when they see utensils, they are meaning the things that we use at home. When they see utilities, they are looking at very many items that are under utilities, monthly subscriptions, maybe TV subscriptions, electricity bills, and others, water bills. So you say you've summarized them under utilities. So we are always trying to make sure that we even regulate on the vocabularies that we use. Someone uses miscellaneous items and someone is wondering what are miscellaneous items, miscellaneous incomes. Some of those, we use some terminologies that are going to be easily understood by those that don't actually have. So even the vocabulary is supposed to be looked into so that we can make the users easily understand the information that has been communicated by these final statements. Therefore, those are the 4 enhancing qualitative characteristics of financial information or accounting information. And the first one, the enhancing, we talked about the comparability, verifiability, timeliness, and understandability. But remember, all these are falling under enhancing qualitative characteristics of accounting information. But we said that the qualitative characteristics of financial information, there are two. We have the fundamental qualitative characteristics and the enhancing qualitative characteristics. And under the fundamental qualitative characteristics, we said we have relevance and faithful representation. We have two there. Then under enhancing qualitative characteristics, we have four: comparability, verifiability, timeliness, and understandability. And those are the qualitative characteristics of accounting information. Thank you for watching. Endeavor to subscribe, share to others. They will also have a benefit to help us also reach a larger audience. Thank you.